So someone was asking another user, like, what would you look for in a strategy being sold by somebody else, right? So there's a bunch of people who, dependent on your on your slant, you might not be the type of person who wants to discover new strategies, like develop new strategies on your own. You might want to get one off the shelf and then implement them. So, are if you had to go ahead and buy a strategy from somebody else, like what kind of thing might you be looking for? What kind of characteristics? I mean, I know you're not looking for promise of 4,000% gain over the next 3 months or whatever. I know that's not what you're looking for. But what kind of characteristics would be on your plate?
Mm, I've been such a solo investor and trader for so long that I've never considered really looking at other strategies to invest in. Typically, maybe another way I would look at this is what strategy would I want to emulate? What properties of a strategy would I want to look at so that I can incorporate it into my own approach in markets? And I'm interested in the general thesis. I start with the thesis. What's the main signal here? What are we doing? What is the main reason that this strategy works? Is it a trend following strategy? Is it mean reverting? Is it some combination of momentum and other factors? Does it only work in stocks? Is it technical indicator based? Like, I want to understand the general factors that went into developing the strategy to, one, sort of quickly create a litmus test that it's not just overfit to some very specific window of time in which the strategy worked perfectly, right? Because that's 90% of what you see out there is, oh, I've got this 90% win rate strategy and it's working perfectly, but it really only works for like the 3-month window that they showed you. So the second factor that would go into this is, once I understand the thesis, is it robust? Does it stand up over long periods of time? Does it seem to generate a consistent result over and over and over again? And when we see those trades, do those trades line up with the thesis as well, or do they appear to be, somewhat lucky in terms of their timing and occurrence? Again, looking for overfitting here more than anything. And then I think the third factor that really goes into this is the performance that's advertised based on a consistent approach that doesn't require leverage, or does it require leverage and excessive risk in order to get the results that it's purporting? Anytime I see like uh, compound annual growth rates over 15%, I'm immediately skeptical that it's likely not taking slippage into account
Right.
or commissions, or it requires leverage in order to get those results. And there's nothing wrong with leverage. If you're willing to take the risk that comes with leverage and you see that as, your approach to markets, and it's the type of risk you're comfortable with, then by all means go crazy. But we all know like how much additional risk comes from leverage. So if I were to buy somebody else's strategy, I would certainly not want to defer that risk to somebody else. If I'm going to take risks with leverage, I want them to be my risks, not somebody else's. I don't want to put leverage risk in somebody else's hands, if that makes sense.
That's right. When I was shopping around for an investment company a few years ago, I remember looking through all these different pamphlets, and I kept asking myself, why do they only give me information from 2009 onward? I'm only getting 2009 and onward performance results. And then I go, well, did your fund run before that? Well, yeah, but we only really provide. Can I have the numbers from 2007 and 2008? Like, what happened during crashes? What happened during major volatility events? And then it
So they
turns out,
cherry picked a window.
exactly. But
Yeah.
it was like all these different the mutual funds, investment companies, whatever, all from the end of the GFC. It's like, yeah, of course, everyone could see the chart went up and to the right. Of course, your numbers look good.
You mean during
Um,
one of the longest bull runs we've seen in history?
exactly, exactly. I should check their numbers again after the COVID crash.
Yeah, right.
But for me, if I'm going to buy something from like um, a strategy off the shelf from somebody, one of these services out there, I'm looking for asymmetrical payouts.
Hmm.
I'm not interested in your 5% per year. Like, I don't need you for that. Especially now with bond rates being where they're at. Like, if I'm going to be risking that, then okay, I want to know that if it pays out, it's going to pay out big. And so I do like leverage trades, and I do like option strategies,
Hmm.
the structured option strategies, because they do nothing. They pay nothing. I know I'm going to lose money on it, right? It's not really essentially paying for like an insurance policy. It just feels like that. But then when it does pay out, you get the what was the name of Nassim's Talib's firm, Hermetica type returns,
Uh,
where
Universa.
you, was it Universa, where
Yeah.
yeah, where
Right.
you can get these massive payouts, and then it's like okay,
Mhm.
then it was totally worth it. So I look for asymmetrical as a term, or convex.
Yeah, convex or insurance-like payoffs. That's what we're looking for, right? Is a low premium cost relative to the payoff if something bad happens. Yeah, I think those tail risks approaches make a ton of sense too. But that's sort of an entirely separate kind of style, right? Like that tells a different story. It's looking at the market a little differently, and usually those types of tail risk approaches are still mostly long bias. They're just looking to insure against the tail events. Um, but I think maybe one other thing when it comes to asymmetry is the way we measure intraday trading strategies. I think many people look at indicators and strategies on TradingView charts and they're like, okay, look, I see a profit factor here of 2 or 2.5, and the win rate is like 60 or 70%. Everything kind of matches up there in terms of my positive expectancy, but then the number of trades that it took was like 3 in the backtest window. And
Right.
so the question you ask yourself is, why not just buy and hold then? If it's only going to
That's
take
right.
three trades over that period of time, you're going to get better results. If you look at the TradingView chart and observe the strategy in its backtest, one of the important, I think, features to look at is how it compared to the benchmark, or buy and hold, if you will. So if it's trading the SPY, for example, or SPY, and the strategy looks good in its performance, but then you compare it to what would happen if you just bought and held, and it significantly underperforms the buy and hold, well, then you have to ask yourself, what was the point? What's the point
That's
in
right.
getting in and out of these positions and risking that, you might set yourself up for consistent losses in a trade when the buy and hold approach is more profitable? So
That's the
I think,
crypto story there. People go, why ever trade crypto if you can buy and hold it and then not have to worry about these types of events?
sure. I mean, it's largely the reason that we tend to argue for longer term strategies to everyone. I mean, not recommending financial advice, obviously, but like it's just, if you look at the data, you will find that the longer you hold positions, the more exposed to the general returns of the market you're going to get. And it's just extremely difficult to get in and out of positions every day consistently, and still beat the buy and hold benchmark without leverage. Like that's the key factor here, is that the only way to do it is likely using leverage,
That's right.
trading futures every day.